Recording in progress.
Hello, everyone, and welcome to tonight's Monday macro update for Monday, February 9th. We had a little bit of a schedule conflict with the Super Bowl, and, we don't want to take away from the NFL because, all 2,000 subscribers on this channel would be viewership lost for, the small viewership for the NFL Super Bowl. So, we spared them. So we moved it to Monday here. So I appreciate everyone's flexibility, but we're going to get into it here. Lots to go over from last week. Huge amount of, market data being published. This week is also a pretty busy week as well. Nothing today. It's really just Tuesday through Thursday that have the largest amount of data dumps. But, we continue to notice this huge shift in the markets right now, right? So we're seeing a capital rotation out of mega caps and into more cyclicals, as well as a continued bull market in commodities, specifically with precious metals. That's all still happening. While at the same time, we are getting a large amount of growth data coming through, right? So despite all of the fear that's going on Main Street, and a lot of the fear surrounding the mega caps, we're continuing to get real market data that the economy is accelerating. And because of this, you want to own things that are benefiting from this large real economy appreciation. And then we're also continuing to get, some near-term disinflation as well, right? So the soft landing narrative, according to the market, is still intact, but the capital is flowing into other things, not what everybody typically owns, and things like in their 401ks and stuff like that. So you have to be a little bit active here to make sure that you are participating in this capital rotation. And also as well, with the nomination of the new Fed chair, Kevin Warsh, we obviously saw the large freak out because Kevin Warsh in the past has talked about, wanting to not be a part of, the Fed put is what they call it, but it's really just a way to describe easy money in the markets by the Federal Reserve, right? So whenever you hear the term Fed put, that just means easy money, lower interest rates or flood the market with liquidity, that sort of thing. And in the past, Kevin Warsh has been critical of that, right? And so now my team and I are of the belief that, whenever people get in office like this, they pretty much just, go with the flow, And we still have yet to see that. Obviously, he doesn't get in there until, I believe, April. But, it's pretty funny how Scott Bessent has already noted that, hey, if he doesn't play by the rules, looking at this headline here, then maybe we'll reconsider something here, But we're going to go ahead and get into all of this as well. And so if this is your first time watching a Sunday macro wrap up on Monday, typically it's on Sundays at 8 p.m. But if this is your first time joining, welcome. My name is Johnny Zerti. I'm one of the co-founders of Macro Optics. And typically the way that these macro wrap-ups work is that the first they're an hour long. The first 30 minutes is streamed online on our socials. And then the second half is we go offline, and it's only meant for the members in our community. And so we have some people on our Zoom call here. And during the second half offline, we will be talking about some actionable ideas as well as answering questions. And so if you'd like to be a part of that, just go to our website, macro-optics.com. And we continue to have a open cohort right now for the most recent 6-week challenge that's going on right now. So if you guys want to learn more about that, just go to our website there, click the video, and you can go ahead and learn more about how to get involved there. If you're joining on YouTube, you can also see the description below there. So make sure to check that out. But let's go ahead and get right into it here with reviewing a little bit about what happened last week, which is, we had some mixed macro data, right? So what was interesting is that we got the private ISM purchasing managers indexes, right, for both manufacturing as well as services. Now, the purchasing managers index, PMI, this is obviously a leading economic indicator, right? Because if purchasing managers for these large manufacturers or service providers are going out and fulfilling purchase orders or putting out requests for proposals, all those different things get accounted in these ISM PMIs. And so obviously if there's a large increase in that, it's going to show up in these reports. And that is a form of private demand, right? And so we see that here in the manufacturing PMI, it accelerated to the highest level since 2022. Taking a look at this here, it's now this is just a 1-month acceleration, and it could be slightly due to the rebound from the holidays, but because this is technically January data. But taking a look at this, it was a pretty large acceleration here. If we go back 5 years, the last time it was at near this level was around August of 2022, and pretty much since, let's see here, yeah, pretty much since November of 2022, the manufacturing PMI has been in contraction, right? So it's been below that 50 level, and when that happens. When that happens there, that's showing that it's in contraction when it's below 50. Okay. So we saw a large acceleration there that is quite positive for the manufacturing sector. While at the same time, we saw that the ISM services PMI also accelerated, and that continues to be in expansion. So both manufacturing and services early indicators are suggesting an acceleration. This isn't a surprise, though, because we see a large continued acceleration in the yield curve, which continues to steepen as well. Right now, it's going back and forth between a bull steepen and a bear steepening twist, which, it's an interesting thing there, which we talk about in our community. We talk about these different phase signals. And typically, what happens during a bear steepening twist, that's typically where you get some inflation spiral, Fed loses credibility, you get debt concerns, loss of faith in purchasing power, hard assets go up. And that's kind of what we've been experiencing. But then the bull steepening is where you get, growth accelerating, and you get excessive fiscal deficits, which is what we're getting as well. And that's more of a fiscal dominance, which is, where you're getting the Fed being more dovish, even though, growth is accelerating there. And then you have a bearish dollar, which is true as well. And so we keep flip-flopping between these different twists here, a bull steepening and a bear steepening twist. We'll see what happens if it makes a definitive move here. But at some point, we're going to have a rebound in one of the different yields. And what I mean by that is typically the normal situation for the yield curve is where you have yields moving co-directionally, which means that if the 10-year is going up, the 2-year is going up as well. If the 2-year is going down, the 10-year is going down as well. And that's majority of the time is what happens. But in these rare occasions, like we are experiencing right now, we get these twists, right? So you get actually the long end of the curve, the 10-year, moving in an opposite direction of the 2-year, right? You get a twisting action in the yield curve there. And so when yields move anti-parallel, it's very uncommon, and you want to be paying attention to that because it typically signals inflection points in the larger cycle. you know. So this year in 2026 has already been shown to be a very pivotal year with this twisting of the yield curve, right? Again, very rare. We want to be pretty vigilant here, and it has been already an interesting start to the year with the acceleration in volatility, the sell off and rotation in big tech. This is kind of like a once in 5 year type of thing. So very exciting stuff, but also you have to be pretty active with your holdings there, because if you're being caught just holding, things like Microsoft and Tesla and some of these things that have been going down a lot, well, then you're just going to be holding the bag, and there's plenty of bull markets that are happening right now. So you have to be going to where the money is flowing. And we'll get into that here momentarily. But continuing on with some of the macro data from last week, private jobs, 22K jobs added in January. This is the ADP report, not the official jobs number. So that continues to decelerate, but stabilize. The big news was that we had a record amount of job cuts in the month of January. So compared to other Januaries, this was the highest January job cuts since 2009, right? Since the great financial crisis. And although it doesn't look as bad as other months, right? Like in March and in October, but considering and comparing to other Januaries, it was a pretty large move, right? So this was the lowest January hiring on record and the highest surge in layoffs since 2009, which obviously is not great for the labor market. And, a lot of Fed governors and people on the Federal Open Market Committee, the FOMC of the Federal Reserve Board, they can use this as fuel to continue cuts. And you did see a little bit of a fluctuation from this report last week with the um, odds of or the probabilities of a rate cut in March go up slightly, but then this week they've rebounded back to that nearly 80-20 probability. And I think as of right now, the first cut of 2026 is being priced in for the June meeting on June 17th. So we still got quite a ways until then. And so, that's what the market is being priced in right now. And really, the Mag 7 stocks don't really like that too much, right? So that's partially why you're seeing some of this capital rotation here. All right, what else we got? Consumer sentiment rises for the third month. So that's pretty interesting, right? So the consumer starting to accelerate in terms of sentiment. Consumer credit also had a very large December. And so, that was akin to maybe a lot of holiday spending. That's more of a lagging indicator, though. But it was definitely interesting to see that there. In terms of sentiment, we continue to see more of like a I'm not sure type of thing from Main Street on like what the market is going to do. But if you're watching this channel, then kind of where the bull markets are at, and you're participating and not a part of the crowd here. But the biggest thing that was interesting to me in terms of sentiment was the Bank of America Fund Manager Survey from January, which for some reason, we didn't cover until now, but we'll go ahead and cover this. So this is essentially the sentiment report for all the big institutional big boys, billions of dollars in assets under management. These are the hedge funds. These are the huge, billion-dollar fund managers. These are the big dogs. And this is their sentiment report, right? Not everyday investors like you and I. And so now the Bank of America Fund Managers Survey has historically been a very interesting contrary indicator, right? And typically at large extremes, it's been paid well to go in opposition to this. Not saying to do that right now, but as we get closer to these bullish extremes within the institutions, we must take note of this just by looking at history here. And so, taking a look at this first chart above here, we can see here that the January 2026 Bank of America Global Fund Manager Survey, this was the highest and most bullish sentiment since July of 2021. And the equity allocation is very large in terms of where these huge fund managers are located at, right? And a lot of it was due to just the large growth acceleration expectation, right? And so recession fears are pretty much at near nothing. So that's pretty interesting there. But if we go ahead and also take a look at, risk taking, the fund manager survey investors are taking a net 16% higher than normal risk levels versus net 4% in December of last year. So this was a large turnaround, right? And really, there's only been a handful of times, maybe not even, where it has been above this net percentage level on a sustained basis and an accelerating basis. One being in 2021, the other being in 2017. You didn't really even get that, you know, maybe a little bit in the dot-com bubble, but yeah, so this is at pretty extreme risk-taking levels in terms of these large fund managers. And then also as well, cash levels have dropped to a new record low of 3.2%, drastically below the risk on level, which is around 4% there. So this is an extreme contrast to April of 2025, which is when this was at a 4.8% mark, not near or pretty close to the 5%, which is typically like peak fear. but but yeah, that's pretty interesting. This is signaling just, hyper bullishness from institutional players, right? 3.2%, lowest on record. That's definitely saying something. That's an extreme. um Continuing on here. A large majority have not taken out protection against a big stock market price drawdown. So net 48% of fund managers say that they have not taken out any form of protection against a sharp fall in equity markets, which is the highest since January of 2018. Low levels of stock market hedging are irrelevant in a world of positive surprises, but it matters greatly if surprises suddenly turn around, which is kind of what we've been seeing over the past week here in February. So remember, this came out in January, or around middle to end of January. So it is interesting how that's the signal. And then also too, when you take a look at allocation, look where these big fund managers are not allocated. Global energy, global consumer staples, the two sectors that have the most bullish trend, right? So when we take a look at something like energy, look at this. There's a bull market. Let's take a look at staples. And so even though that these sectors have been accelerating pretty much over the past 6 weeks, we can see that they are severely underweight in these exploding sectors here. And so a lot of people are like, oh, I may have missed the boat in something like staples. Well, obviously, with it being at the top end of the trading range, you wouldn't want to just buy a big chunk of this. If you're trying to get an entry point, you would want a little bit of a of a price correction to the low end of the trading range on lower volume. But I don't think that this is over at all. And what's also interesting is you're seeing some other emerging developments. Namely, we'll get to some others offline for just the members, but one of the main ones that we're looking at here is financials, right? One of them being driven by JP Morgan stock, JPM. Look at this. So massive acceleration. Again, not buying it here because it's near the top end of the trading range, but take it as a signal and then put it on the list to buy dips. So that went bullish recently in our model there. So it is interesting seeing Main Street everyday investors uncertain and seeing the large fund managers historically bullish, and you can argue with some of those things that we just looked at, the most bullish ever in history. So it's definitely interesting to see that there, but there's no denial that growth is accelerating. Now we can argue if that's mostly due to the large amount of government deficit spending that's going on, given, if we take a look at, let me go to our website here, the market dashboard. On our website, if we go to the market map here, looking at the government debt to GDP ratio, you can see that the United States government debt to GDP is 128.75%. That is absolutely ridiculous. The last time it was that high was World War II, and it's because we were in a global war, right? This is technically quote unquote peacetime, and we're just at these extreme levels, right? So, yeah, let me see if this is okay. Yeah, so the last time, look at this. So the last time we were at this level, actually, it's higher right now. 1945 was the last time we were at these peak levels. And you can see ever since quantitative easing and 2008 great financial crisis, this has been creeping up. And then COVID really exploded this from 100% debt to GDP to 126, and it's remained near that level. This is unsustainable. And at some point, all of this leverage that's in the system has to be drained. And I don't think it's going to be super painless, let's just say. But yeah, speaking of leverage, with the nomination of Kevin Warsh, we still have yet to see if he's actually going to be dovish or hawkish. But the market certainly took it as an opportunity to deleverage a lot of the positioning and a lot of the froth that was going on within the precious metal space, mainly with silver, which is having a pretty decent bounce here, as well as gold and copper. Gold actually held up much better than silver on that drop. And so silver is bullish now again, but copper and gold remain our team's focus on that dip to continue to buy, because gold never changed trend. Silver did go neutral briefly, but yeah. So I mean, I think the dip in metals was mostly like a leverage clear out, and now it's reset and it's about to have its second leg. So I don't think that bull market in metals is over by any means, especially at these large debt levels. And then also too, last week we saw the super large crash in Bitcoin prices, now at $70,000 per Bitcoin. That had a pretty decent bounce from 60,000. And a lot of people were getting excited about this bounce. But you know what? In bear markets, that's when things tend to have the largest single day or single week appreciations, right? Some traders, they get super excited when bear markets happen because they know that fact, right? If you go back and look at the history of the S&P 500, the largest single day positive moves or single day largest weeks in the S&P 500 were all during bear markets. 2022, 2008. It's because of these aggressive bounces, right? And so I personally don't play those. There are some people in our community that do, and they're successful at it. God bless them. But all that to say is, you're going to see some bounces, right? The harder things go down, the bigger they bounce. And but at the end of the day, it has not changed trend. So Bitcoin, Ethereum, even Bitcoin miners still remain in bearish trend despite the bounce. So we'll keep an eye on those, but that's what that is there. And then, like I mentioned before, Mag 7 stocks had a pretty large deceleration last week and are now in bearish trend in our model. Things that are more bullet, or things that are also bearish, Qs, which are basically the Mag 7 stocks. When you take a look at QQQ, which is the ETF for the NASDAQ, you take a look at the holdings and it's basically the Mag 7 stocks, right? NVIDIA, Apple, Microsoft, Amazon, Meta, Google, Tesla, right? Those are the largest weights within the Qs. So no wonder why they're bearish. No wonder why Qs are bearish right now. So, yeah, I don't think that this is over by any means, right? But it doesn't really matter. I'm not trying to make a call if it's over or not. But but yeah, we're going to be continuing to be long things that are making higher highs, and things that are breaking down, such as Mag 7 stocks, Qs, things like that, there's better things to own. All right. And so with that, net central bank liquidity continues to remain, near $2 trillion. It's fluctuated a little bit up and down, but it's kind of remained flat. And the rate of change has been negative. So if you go on our website here and you go to net central bank liquidity, you can see the rate of change of this metric. And right now, as of February 6th, this was last Friday, negative $302 million in outflows. So you can see that it's still remaining negative here. Once this starts to get positive again, that's when you can, maybe start to see more of these liquidity sensitive assets like Bitcoin start to perform a little bit better. But as of right now, this remains in a bearish trend. So liquidity is definitely not plentiful, but there's still a lot of bullish trends. Taking a look at these super important ETF ratios that we use as real-time macro indicators. Consumer discretionary versus XLP is in a bearish trend, which is more of a risk-off signal. You also have emerging markets versus the S&P 500 ETF SPY, and this is showcased that emerging markets are winning or seeing more capital flows. So capital outflows out of the S&P or out of the United States markets and into emerging markets. Let's see here. TIPS, TIP versus IEF ratio. This is a great ratio for essentially looking at like a real-time credit spreads indicator. And I think I have this upside down actually. But credit spreads remain narrow. I'm sorry, this is the one for credit spreads. I'm sorry, IEI versus HYG. This is for inflation. We got some other ones here. Copper versus gold as well. And then ITB versus SPY, which is hint, showing that the housing sector is starting to gain strength and is one of the more emerging trends, which we'll talk more about here offline. But that is pretty much all I have for you guys here. Interesting looking at the heat maps. Taking a look, there was a pretty decent bounce here today. NVIDIA, Microsoft. Taking a look at the monthly performance, you can see that, having a pretty interesting bounce here and things like NVIDIA, Apple, Broadcom, Google, Microsoft in the red. Interesting to see that there. But yeah, so some of these heat maps that TradingView has now are awesome. Would highly recommend you guys use these. But all right, we're going to go ahead and go offline here to our Macro Optics members. So for those who are on the Zoom call, make sure to stick around. I'm going to go ahead and we're going to say goodbye to YouTube, TikTok, and Instagram. So just hold on one second and we'll go ahead and continue the discussion here momentarily. But bye, social media. We'll see you on tomorrow's daily macro update at 3:45 p.m. Eastern time.